Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shereen Bhan. Well, it is that time of the year when we ring in the festivities, and Diwali in particular symbolizes the victory of over inertia and the start of a new cycle with the light of clarity and positivity. It wouldn't be wrong to say the Indian startup ecosystem has rounded off a cycle of its own, hitting the concrete hard from the record-breaking highs of 2021, followed by a bitter correction over the last 2 years to now finally emerging with a sense of sturdiness and signs of spring. 2024 is set to become the best year for startup IPOs since 2021, when Zomato, Paytm, Nykaa and others raced to the Lal Street as flag bearers. So far this year, we've seen the likes of Ola Electric, FirstCry, Digit, Exigo, Unicommerce, Office starting their public market journeys. More are on the way, with Swiggy, MobiKwik, BlackBuck and Ecom Express set to get their fireworks going, with plans to list before the year closes. Now, if we assess the venture capital funding data for the 9 months so far in 2024, it's been better than 2023, with $9 billion having come into the ecosystem, a tad bit more than what the Chinese market has received. This as per data from Traction. We've seen 6 unicorns take flight in 2024 compared to just 2 last year, and that's come on the back of large deals returning with as many as 12 funding rounds valued at more than $100 million each. Besides the big highlight of Zepto's $1 billion fundraise in 2024, it's the secondary share sales that have fueled $100 million rounds in the Indian startup ecosystem. The strong IPO lineup and the emergence of secondaries have offered much-needed mode of exit for early investors, challenging the long-held notion of Indian startups being trapdoors for funders. Sectorally, the AI hype is flatboarding. India's quick commerce players have turned into global outliers, albeit with some regulatory noise that has also plagued the fintech sector. So what does 2025 have in store for India's startups? Before I get into that, let me start by wishing all our viewers a very happy Diwali. And it's time now to welcome our guests on the show, Karthik Reddy, the co-founder and partner of Blume Ventures, and Hemant, Mohapatra, the partner at Lightspeed India. Karthik and Hemant, thanks very much for joining us on this special edition of Young Turks. A very happy Diwali in advance to the two of you as well. Karthik, I gave a very brief but a quick snapshot of what the year has held out as far as India's startup ecosystem is concerned. Let's dive deeper into some of those headlines. What, to your mind, Karthik, and I'll start with you, has been the biggest takeaway of 2024 for India's startups so far?
I think definitely the path to liquidity cycles being, predominantly the IPO sort of, journey and the route has become very clear that India will have to pursue that. If you have a domestic company that's actually trying to build value within the boundaries of this country, eventually whether someone's acquiring it, someone's trying to buy a secondary in a unicorn, or whether someone actually thinks this is a sustainable business, they all approximately look the same. If you ask a private equity player to come and buy into a large digital company, they want to know whether it makes money, whether it's going to get to EBITDA, not right away, but in 2-3 years. And I think they were more adventurous in 21-22. They've gone back into the same mode of judging a company as if it were IPO ready. And so I think the learning for at least the Indian lot that where we're building for the market opportunity that is India is that you have to build within the constraints of what the profit pool in India demonstrates, and then you're judged by the public markets relative to what else is out there. So if you're Mama Earth, then it's Unilever and Marico. If it is Paytm, then it is an NBFC or a bank, and so on and so forth. So I think it's great that we have that momentum now building up. If we end the year with 12 to 15 IPOs, and we can keep this momentum going for the rest of the decade, suddenly we'll have 100+ companies listed across small, mid, and large cap in Indian tech. And I think that'll be a watershed moment to welcome the next decade. I know I'm talking very far out, but I feel what we started this year is it's going to become a consistent trend line over the rest of the decade.
Well, that certainly is the hope, that we will see this consistency being built out. And you're right that, the comparisons are being made between startups and, of course, incumbents. But there are startups that have been category creators, companies like Zomato, that are actually setting the metrics in many ways for a new sector. But Hemant, let me ask you, to Karthik's point, what would you signify as the big takeaway for the Indian startup ecosystem in 2024, outside of the fact that we've seen this spate of IPOs? And I think it would have been unimaginable unimaginable even a couple of years ago that India would have been the IPO nation versus the US market, for instance.
Yeah, and absolutely. Thank you again for having me here, Shereen, and good to see you, Karthik. Always a pleasure. Look, I think Karthik is absolutely right. When capital was easy to raise and easy to deploy, there was a glut of capital around the world. Now that it is harder to raise capital and deploy capital, there's a flight to quality in all dimensions of our business. There's a flight to quality in businesses and business models, teams, and even investors. So we are seeing that happen across all the geographies Lightspeed operates in. So that is a theme we are seeing in the capital markets globally. From a thematic perspective, and I would say AI is looming large in every single category out there. We are seeing AI leading to a resurgence of consumer tech. And I know consumer tech has gone through a bunch of ups and downs over the last few years, but now there is a wave of new consumer tech companies, new modalities, new behaviors that AI is enabling that is making it a very interesting category for us to invest in. We've done a bunch of those this year. We're also seeing a resurgence of hard to build companies, hard to build technologies. And you can call it deep tech, you can call it frontier tech, you can call it infrastructure tech and software. But we are starting to see a lot of net new companies coming up and attracting a lot of high quality capital that are building hard to solve problems globally, especially coming out of India as well, which is a net new thing for us and is a theme that we are digging in a lot more now.
I just want to double down on that last point that you made, Hemant, about these hard-to-build companies that you are placing your bets on, and whether you like to call them deep tech or frontier tech, I'll leave that choice to you. But give us examples of the kinds of companies that you've invested in and what those check sizes look like at this point in time.
Yeah, so as a fund, we have been pretty active in what you could call frontier tech and deep tech. But maybe just zooming out from there are companies that are hard to build in different ways. We are investors in a company called Zepto that is hard to build in a very different, operationally intensive way and requires a lot of capital to prove a business model out. And then we have companies like Pixel Space that needs to get heads down for 3 to 4 years in the lab and prove the science and the engineering risk behind their approach before they come out in the market to raise more and more money. So we have looked at both of these categories, and like I said before, the capital is now flying towards companies that have built businesses of high quality, whether they are operationally intensive and require a ton of capital to prove the business model out. They are attracting a lot more capital now once they have gone through that needle hole. And companies like Pixel Space that have actually spent 3 to 4 years building world-class, de novo, net new to the world technologies, and now they are kind of reaching commercialization stage. They've also gone out and raised a lot of capital globally. So we are seeing a bit of both happen in the India market.
Well, speaking of raising capital, I mean, you talked about Zepto, and it's almost like the taps are on, raising over $1 billion just in 2024. That's been the story. But Karthik, let's just pick up on this quick commerce story, because we spoke about this, including at the India Business Leader Awards jury, which you were a part of. And the point is not just that these are companies that are trying to do something that's hard to build. The disruption that these companies are creating across different sectors, the fulfillment expectation that these companies have managed to change, whether it's Zepto or Blinkit, and now more and more companies are getting into the fray. Do you believe that this quick commerce story is going to be the clear India outlier for the next decade?
I think it definitely rewrites a lot of rules, right? Unfortunately, our early pick in this space, Dunzo, became a victim of this, little bit of a capital bloodbath and fell behind. Sadly. But, we were believers that the delivery model required disruption, and it required rethinking in a market like India, where you don't have big format retail like you did in other markets. And you have high density in almost 20, 30, 40, 50 cities, and which is where the biggest part of Indian consumption is concentrated. It's not, by the way, we are also contrarians, in the sense that we don't think quick commerce, for example, will work in tier 3, tier 4 India. And we actually have 3 to 4 retail or supply chain bets into tier 3, tier 4, which we started 2 to 3 years back. So we are always, as guys who do early stage, we have to be ahead of the frontier. I'm commenting on something that all of you are aware of now when it comes to quick commerce. What I'm seeing, though, to your point, is it is forcing both D2C brands, conventional retail, conventional FMCG, to rethink business models. And then every time that happens, just as AI is doing in the polar extreme of technology, this is more around logistics and supply chain, it's forcing people to rethink how to rebuild supply chains. And if you actually build a picks and shovels business that fuels, an acceleration to this business model, you could build a very, very valuable company. So now we're seeing plans around, dark warehouses on the cloud. We're seeing, how do you get we are beneficiaries by way of Yulu and Battery Smart, which are actually supply to the quick commerce model. So the picks and shovels businesses are beginning to pick, right? The logistics businesses have to be rewritten. I don't know what delivery will do, and I don't know what Ecom Express will do to be able to, shift their model to be able to compete with these guys. Similarly, as you're seeing, Flipkart and Big Basket are all forced to compete. Let's see if Reliance and DMart also get into that. So I think the hybrid retail business model is something that quick commerce brought about. And Shereen, if you look through history of consumer behavior change, it feels like it happened overnight, but usually it is something that has been playing for 3 to 6 to 7 years. And usually it comes at a tipping point. Need a certain economies of scale in terms of behavior. You can't force fit it, right? You can't throw $1 billion at the problem if the behavior was not ready. And, to Zepto's credit, they've built remarkably fast. But I'm saying if you go back in time, all of this it's an extension of the food delivery business that Swiggy and Zomato started, right? You had to have people on two-wheelers which could zip around town and give the stuff. That couldn't have started with just grocery. Food was a better use case for that, and so on and so forth. So I think we are at the cusp of very interesting behavior change in India, which a lot of other markets haven't seen, and we are able to deliver at a cost which none of the other big markets can. Which means that clearly we're sitting at a different consumer behavior paradigm than most other Western countries are at.
Well, yes, an inflection point there as far as consumer behavior is concerned, and you're right, it doesn't happen overnight. There have been many changes that have come into play to ensure that this is in fact a reality, and one that perhaps will eventually make money for everyone involved, or at least for those who are in the leadership positions. But Hemant, let's move and talk about another sector where there's a lot of promise and a lot of hype, and it's a sector that you know well. This whole semiconductor story that India is hoping to be a part of, and the government is putting big ticket bets on this as well. Now, who would have thought that we would be in a situation where you've got the possibility of a Qualcomm trying to pick up an Intel, but that's the scenario that's playing out globally. Now, in that space, what's the role and relevance of India, and particularly for Indian startups who are likely to be beneficiaries of what's happening within this space?
Yeah. I think this is a fascinating space, and I'm an ex-AMDer. I was a design engineer at AMD many years ago, both CPU and GPU. So this is a space that is very close to my heart, and I would love to back somebody building a next Intel, next NVIDIA, next Infineon, next Texas Instruments out of India. Now, if you look at the overall landscape of what it takes to build a great semiconductor company, design talent is at the heart of it. And if you look at what kind of design talent India has, I would say maybe about 20 to 25% of Intel's design talent sits out of India. About the same for AMD. 12 to 15% of Texas Instruments design talent sits out of India, and so on and so forth. So, we sort of pride ourselves by saying that we are in the people business. You pick the right talent, you supply them with the right capital and advice and connections, magic will happen. So at this point in time, given where we are seeing the supply chain of silicon, we are seeing it fragment geographically. AI is absolutely accelerating it, but the old guard of semiconductor, there are large companies and sovereign nations that are trying to build sovereign capabilities, so they're not over-reliant on the old guard. It happens to be the TSMCs and companies like that. So we are seeing a tailwind coming together, and India has a talent base. Now the challenges are going to be massive. I think the The failure mode in this category is to build an IP first technology company that sells IP to a different company which owns the consumer brand and hearts and minds. That would not be a good answer for us. And to build a high quality semiconductor company requires somebody to pull together a high quality team that understands design, that understands fabrication, at least has the connections in the market to fabricate that effectively and quickly and without a bunch of errors. It's expensive in this in the semicon category, to package it, to work with the ecosystem. So when you design a chip, it actually goes into a motherboard and is not misaligned to what the motherboard specifications are. And then finally, and this is an important part which gets missed a lot, is how to position and brand and market and sell it. Do you sell it to the end consumer like you and me? Do you sell it to the big hyperscalers? These are very different strategies. So in the absence of all not coming together, we will not build the world-class company that we have the potential to build. And of course, it requires a lot of capital to get, and some of it will have to be government funded, and some of it will have to be venture funds like ours.
Yes, Karthik, speaking about venture funds, and I want to understand from you what we're seeing happen on that front. We have seen a pickup as far as funding is concerned, but let's talk about domestic capital and unlocking domestic capital. I mean, whether it's folks like you or now, even folks like Titan Capital. I mean, I was talking to Rohit and Kunal just yesterday, and this whole unlocking of family offices, Indian family offices, of course, the Indian startup community that is now trying to also give back or look at this as a lucrative way of allocating their own capital. I mean, 2024 has been an interesting year for the rise of new venture capital in India. Would you say that?
I think it's a year where things are stabilizing a bit. I wouldn't say we've added too much. I think the additions happened over the last 2, 3, 4 years. So we've had an explosion in new managers who, as you rightly said, raised predominantly from India. And it's a surprising trend because Indian investors stayed away from very long-term locked-up capital, which is what venture capital is, right? Somewhere in the middle part of the last decade, I think the appetite was beginning to get whetted, given the headlines were like, Tigers made so much money, or SoftBank has made so much money of some of our biggest unicorns, and they don't get a slice of it at all, right? But from what I recall, AIF regulations came in 2012, which made it a little more streamlined to raise from domestic pools of capital. And what got raised between 2012 and 18, Shereen, I think between 18 and 22, there was 10x more capital coming from domestic shows, right? That's what we heard in IBCA. So what it meant is that there's a lot more appetite to take that risk. I would actually argue to the contrary that it's actually slowed down a little. I'll tell you what I mean by that. Playing blind into a capital pool that's a venture fund is less appealing than playing directly into companies. So if you saw today, Zepto, for regulatory or other reasons, is able to tap into Indian family offices for direct investing. So is ACO, right? These are the headlines in the last 2 days, right? Zepto and ACO are able to tap into large Indian family offices. And I think Indian family offices are getting savvy. If there was another article or somewhere that I read about the quality of talent that's going up in Indian family offices. So you're suddenly building Indian family offices becoming as professional as venture funds suddenly, because they're taking direct exposure, right? So we might be writing 10, 50 crore checks to start a relationship. They're writing 100 crore checks into a single investment, right? So they are becoming sort of mid-market PE/pre-IPO kind of investors, if not classic venture investors. And it's wonderful to see the spectrum of risk evolve in India. And I don't think it'll be one size fits all. I think a lot of their investing into funds like us is more experimental. They're buying pipeline to understand the market better, to be able to look at what's coming down the pipe, understand trends. They all come very attentively to our AGMs. They hear what's going on. And then they want to play the best of those companies as they're breaking out. And they're getting close to public when actually, ironically, most of the funds want to exit. And Indian investors are saying, it's our market. This is a company that can grow 10x like a Zomato. I'll buy into it now, right? And so they're getting savvy. And it's good to see this. It's good to see this because that you can't rely on SoftBank and 10 other SoftBanks to buy out all our late stage risk. It's a path to public risk, which only the Indian domestic capital should, sort of anchor. And that's happening a lot more, I think.
Well, Hemant, what's your thought on the anchor that has emerged in the Indian startup ecosystem driven by domestic capital?
I mean, look, I mean, one of the biggest beneficiary is the IPO market, right? So it used to be that majority of the capital going to public markets in India was foreign. Now it is well balanced, and actually at some point in time it was actually much higher on the domestic side. And what is really exciting for us is that while of course the valuations may be a bit inflated compared to our peers in the same category in US and other European markets, we do think the uh, the the uh, the potential for upside in India is just so much higher. The internet penetration is still fairly low. E-commerce penetration is still fairly low. Wealth tech, health tech, insurance, all these things are still very, very nascent in India, which is the reason why these multiples are much higher, sometimes 2 to 3x higher for the same category in India versus in the US. The other thing I'll add is well, I think India is an attractive destination because, as we saw with Unicommerce, even small to mid-size IPOs are getting a lot of attention. It is very hard for some of these companies to provide liquidity to their investors in other markets, especially US and Europe. In the US, you've got to get to about $500 million of revenue to even be noticed by the ones that build their IPO book. But I think India market in IPO is where the US market was probably in the 80s or 90s. If you just take an example like Amazon, when they IPO'd in 96 or 97, I think they had about $15 million of revenue and they had no profit. I mean, they didn't have profit for many, many years after that. Netscape that IPO'd in 95 was $11-12 million in profit, sorry, in revenue and zero profit. They IPO'd at that stage. And then when you allow these kind of companies to healthily IPO at the right valuation, a lot of the benefit goes back to public market investors, which are primarily retail over time. So I think it's a really good trend that we are seeing continues.
Well, Karthik, one of the concerns, though, and I don't want to generalize this because these are specific events and specific incidents involving specific companies and specific investors, but that has been the sort of dark cloud hanging over the Indian startup ecosystem through 2023 and 2024, and especially when you have what you would have thought were, the poster child, the poster boys of this space, face the kind of music that they are facing today and virtually in an existential crisis, it does put to question the governance metrics that people are operating with. How much of that is a concern today and how much of it is being acknowledged and being worked on in terms of course correction? Karthik.
I think it's a kind of I would say those cases that you talk about are itself nuanced and layered. So outright bad behavior in terms of punishable offenses, I think are a very small number, Shri, right? The second is a little bit more rampant, I would say, which is do they know how to manage their capital, their runway in a down market when capital is tight? Can they control costs? Can they turn profitable? I don't think that is as much as governance as exuberance that has to be curtailed. And if somebody didn't do it on time, companies have blown up as well. It's happened all through the history of venture. It's not unique. It's just that nobody had seen a correction and cycle in this particular bull market for like post-GFC in venture, right? And it peaked 14 years in as opposed to usual 7-8 year cycles. So I think it got a little out of hand. But when you look at even those collectively put together, there's not probably more than 20-30% of startups which are in trouble. Yes, you might say it's a large number, but you'll see that even in stock market downturns usually. So I don't think it's fair to not compare it with what would have happened in a public market downturn necessarily. That's one. The second, and that's why you have bankruptcies. They happen in the US, they happen here. Chapter 11 exists because of that. Now, there's another 25, 30, 40%, including companies in each one of our portfolios in venture, where I think the founders have been smart that to acknowledge that they got lucky with a lot of money in 2021, 22, course-corrected in time, will not maybe hold a candle to the valuations from 21, 22. And if you realized First Cry and some of these folks, they all listed at down rounds, right? So I think there's an acknowledgement that this is not a one-way street to go up. Markets will correct. And you have to correct your valuation and your inherent value expectations that you set with your investors to more realistic levels. And you can't wing the public markets, and private markets are absent at those levels any which way. So I think most of them who want to believe that they're building for 10 more years, 15 more years, and they're building sustainably, have done a great job of course correction, I would argue. And then, the last 30, 40% are actually doing well. The numbers are like 2x, 3x from where they were 2, 3 years ago. And they're riding. So I think it's a mixed bag, and you're absolutely right. You can't generalize. What you should be worried about is, have we finished the cleansing? And I thought it'll be done by 24 end, if you ask me. I think it's still a year and a half. Right? I said that last year.
A year and a half.
But it's still going to take 12 to 18 months to fully cleanse. It's not done yet.
It's not done yet. Hemant, you agree that the cleansing is not done yet? And as Karthik pointed out, I mean, you've got some of your own portfolio companies that are going through difficult times at this point. On the resetting of expectations, on the recalibration of valuations and the cleansing that Karthik spoke of, where are we today, and how much further do you believe we need to be in order for us to be able to get that reset?
Yeah, maybe let me add a few thoughts, because I generally broadly agree with Karthik as well. But when there is a glut of capital, it does affect money, does affect behaviors. We've seen that happen over the last couple of years, and we certainly are seeing correction in the market. What is true now, which wasn't true a couple of years ago, is that having a down or a flat round used to be a ding on your resume. That is no longer a ding on the resume. Which is making a lot of these conversations easier for the boards to happen, for new investors to look at a company and think about, well, why is this company raising a down round? It used to be a negative chatter in their heads. Now it's no longer that case. What this new wave, or the post-Zorpira wave, is bringing full center and attention, is that a company's primary job to exist and reason to exist is to solve a problem that a consumer will pay money for. And for better or worse, when capital was freely available, that had become the primary job of the founder, to go raise as much capital as easily as possible. And then that did lead to bad behavior, lead to defocusing of the business. It did lead to overspending in an inefficient manner in many ways. I think all that attention is now coming back to, well, what is the core reason for my business to exist? And in some cases, the business does not need to exist. We've had those companies shut down as well, where they were scaling and flying quite high during the pandemic, and post-pandemic behavior shifted back, and they don't need to exist anymore. So they had to return capital, and this was a collaborative discussion between us, the board members, and the founders. So we've seen all of this happen. It's hard to really call whether it's going to take another 18 months or not, but I certainly see the trend lines are positive, and we are seeing a lot of that cleanup already happening across the portfolio that we have, and also portfolio that we see as net new investors in other people's companies.
Well, it is the season for hope and optimism. So let me end by asking the two of you, and Karthik, I'll start with you. What gives you the most hope as we look at 2025, and where would you place your biggest bet on? Is there a sector? Is there a company? What do you feel most confident of in 2025?
Me, the theme all year, we have like an annual theme, and it's been about doubling down around our right to win globally as Indian startups, right? And historically, that was understood to be the domain of just software companies, and we actually think that's changing. We actually think we can win on hardware, we can win on hard tech, agri-robotics. We are co-investors with Hemant in Pixel. We're seeing the courage of founders who are now exposed to things that we never were at their age, to say that, why stop at Indian boundaries? So I feel like, in the future, 40, 50%, and that's when you ask me, what am I looking at? If we raise a new fund next year, it's going to be indexed a little higher on our ability to win in global markets, which means we're chasing global revenue pools. And I think it's, that the whole semiconductor question you asked about, if we have supply chains now to deliver the cheapest raw material for what is required to compete in the future, then we'll be even more equipped to go and win against the world. I won't fund semiconductor like chip, fab units, but everything that leaches off that, I want to be a party of, right? To build for the world. So that's my hope, that we actually have stellar outcomes across consumer health, consumer education, deep tech problems like space, agriculture, where we can service the world over the next decade and a half.
So right to win in global markets, that's the big theme that continues to dominate Karthik's playbook for 2025. Hemant, what about you?
Yeah, I think we are, as investors, we are at a very, very lucky point in time in the evolution of technology. Every 10 to 15 years, a new wave reaches an inflection point. And those who enter the world of investing and founding companies at the beginning of that wave, when they come out 10, 15 years later, a zero gets added to the outcome sizes. A zero gets added to the revenues that they are able to build. A zero gets added to the number of people that can be serviced through the technology. This happened in the 90s with internet, happened in the 2010s with mobile, and now it is happening with AI. And we believe that, people say, hey, what is your AI investment? We don't think of it like that. We think the question is as moot as asking, what is your internet investment? There is no such thing as AI. It will permeate and absorb every little thing that humans are going to do over the next 10 to 20 years, maybe even more. So what is exciting for us, there is a new technology wave that has reached an inflection point, but it is starting to look very hard to differentiate that from magic. And that will lead to new behaviors, new human population scale behaviors across consumer, across enterprise, across deep tech. Even hard to do things are going to be possible, where you could deploy AI to design new chemistries for us, new materials for us, and so on and so forth. So it's like a smorgasbord of interesting stuff that we can look at globally and invest behind. So it's a really space for us.
Well, Hemant and Karthik, many thanks for joining us on this Diwali special here on Young Turks to take us through the interesting intersections that you're going to be playing on and what you're watching out for in 2025. Always a pleasure. Wishing you, your families and your teams the very, very best from all of us here on the Young Turks team. And with that, it is time for us to wrap up this special edition of Young Turks. From all of us, here's wishing our viewers a very happy, safe and prosperous Diwali. Thanks for watching.